Welcome back, traders. Thanks for joining me here today. The next long-term pattern on our list is the wedge chart pattern. A wedge chart is a chart pattern that has two converging trend lines on a price chart meeting at a point called an apex. A wedge pattern can exist as a rising wedge or falling wedge. The falling wedge technically forecasts a potential bullish interest, while the rising wedge technically forecasts a potential bearish interest. The wedge long-term pattern can be implemented for continuation or as a reversal trading strategy in the market. Here's the rising wedge on this chart. We can see how it reversed the bullish trend here into a bearish trend. Here's the falling wedge in this market. We can see how it put an end to this bearish trend, thereby reversing this bearish trend into a bullish trend. Before ever planning to implement the wedge pattern for a trading strategy in the market, there are some key factors traders need to ensure in order to determine the genuineness of this long-term pattern in the market. These key factors are: number 1, a reliable wedge pattern must have well-filled edges. Number 2, a reliable wedge pattern should have at least altogether a total of 5 points of upper and lower rejection of wedge. The more upper and lower rejection of the wedge pattern has, the more reliable the channel becomes. Number 3, a reliable wedge pattern should not have price filled up to the apex. These are the 3 main key factors to determine if a wedge pattern is real or not. Now, let's discuss how to trade the rising wedge. A rising wedge is formed when price consolidates between the lower upward sloping support and the upper upward sloping resistance lines. As we can see on this chart, the slope of the lower support line is steeper than that of the resistance line. This indicates that higher lows are being formed faster than higher highs. This price transformation leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. We have discussed this pattern formation in one of the classes in this trading course. Therefore, we won't spend much time on the rising wedge pattern. I will proceed to show you how to take the measurement objective of this pattern. To forecast the profit target of this pattern, you need to take the vertical measurement of the pattern from its starting point, that's from the resistance trend line of the higher high here, to the lower trend line of the support here. Next is to replicate this measurement value from the bearish breakout point here downward. This measurement price objective becomes more powerful if it aligns to a key level on the trading chart. In this case, the bearish move went lower than the measurement objective target. The rising wedge can also act for the continuation of a bearish trend. Here we can see the trend was in a bearish phase. The bears made a short break, thereby giving room for the bulls to exercise a short buy order. The bullish pullback in this bearish trend resulted in a rising wedge in this strong bearish trend. We can see after the bears set in to break the support of this rising wedge, the bulls gave up and the bears resumed the previous bearish trend downward. Stop loss is suitable above the last swing high here. This would be an opportunity to add to our selling position or trade in the direction of the dominion trend in this market. The measurement value from the high to the low here can be replicated as the measurement objective profit target in this sell setup. In this case, the bearish move went lower than the measurement objective target. Let's see how the falling wedge can act for the reversal of a bearish trend into a bullish trend. The falling wedge can either be a reversal or a continuation signal. As a reversal signal, it is formed at a bottom of a downtrend, indicating that an uptrend would come next. As a continuation signal, whenever it formed during an uptrend, it implies that upward price action may resume. Unlike the rising wedge, the falling wedge signals a potential bullish move. As we can see on this chart, the falling wedge serves as a reversal signal. After a downtrend, price made lower highs and lower lows. Notice how the falling trend line connecting the highs is steeper than the trend line connecting the lows. Upon breaking above the top of the wedge, the pair made a nice move upwards that's approximately equal to the height of the formation. In this case, price rallied beyond the measurement profit target. Let's take a look at an example where the falling wedge serves as a continuation signal in a bullish trend. As we can see on this chart, whenever the falling wedge forms during an uptrend, it usually signals that the trend will resume later on. In this case, the price consolidated for a bit after a strong rally. This was a signal that buyers are gearing up to build more bullish momentum to continue the bullish trend. We can see how buyers resumed the bullish trend in this market. To make an entry on the wedge pattern for the continuation of a previous trend, traders can set an entry order to catch the bullish breakout of this pattern. The best zone to set stop loss would be at the last low swing here. Traders can replicate the measurement objective value of the pattern here as the profit target for this buy entry here. Now you can see that the wedge is another reliable long-term pattern that you can utilize to build a consistent and profitable trading strategy in the market. As a beginner trader, always ensure a lower high swing accompanies a rising wedge bearish breakout. Also, ensure a higher low swing accompanies a falling wedge bullish breakout. Remember, there's no trading strategy that's infallible to the market. Ensuring these factors would help you to stack the odds in your favor, thereby increasing your winning rates in the market.